Thinking about investing in Canadian real estate but don't know where to start? In this video, we will review our top 5 tips to help you choose the best investment property, whether you're a newbie or a pro. Unlock the secrets to building long-term wealth, generating passive income, and maximizing tax benefits. I'll be dropping tips throughout the video, the ones that we actually give to our clients, so make sure you watch all the way to the end. In this video, I'm going to cover the location, the principle of buying for future appreciation, property valuation, the 3 ways to assess a home's value, investment objectives, understanding the different kinds of real estate investments so that you can choose the best one for you, mortgage tips and info you probably didn't know about, and real estate market updates. You can't time the market. So what other metrics can you look at? Since I'm in Calgary, I'll be using Calgary examples. Now this video is longer because we are giving you the goods and we have broken it up into chapters so it's more digestible for you. So feel free to save the video if you can't watch it all in one shot. Tip number 1, location. Buying for future appreciation. In Canada, residential properties that are located in desirable neighborhoods with access to amenities like parks, schools, shopping centers are highly valued and can command higher prices that generate greater rental demand. So for example, in Calgary, neighborhoods like Mission and Bridgeland are popular among investors because they offer easy access to downtown, the river, and trendy shops and restaurants on 17th Ave. When it comes to commercial properties, location is also important. Properties located near major transportation routes like highways or public transit options tend to be highly sought after. And you're only 1 train stop away from the Bridgeland C-train station. In Calgary, areas like the Beltline and downtown core are prime locations for commercial investments due to their proximity to major transportation hubs. Another important factor to consider is the economic outlook for the city or region you plan to invest. In Calgary, the city's strong economy, growing population, and diverse real estate market make it a great place to invest in. The city's oil and gas industry, as well as its growing tech sector, provides a stable job market and steady demand for rental properties. In addition to location and economic factors, it's also important to consider the ownership and intended usage of the immediate areas where you plan to invest. Make sure to research the zoning and land use regulations in the area and to ensure that you're investing in a property that is suitable for your goals. Here's our pro tip. Contact your municipality responsible for zoning and urban planning to get information on the city's future development or redevelopment plan. This can help you determine whether the area is expected to grow and develop, which can impact your property's value in the long run. Some cities in Canada are currently undergoing rapid growth and development, and areas that were once primarily residential may now be zoned for commercial or mixed use. For instance, in Calgary, the East Village area has been undergoing massive transformation in recent years, with new residential and commercial developments popping up alongside the Calgary Central Library and the National Music Center. Lastly, don't forget about safety and crime rates. Properties located in neighborhoods with low crime rates tend to be more valuable and more attractive to potential renters. In Calgary, neighborhoods like Varsity and Haysboro have low crime rates and is very popular among families and young professionals. Here is another pro tip about location. Anytime there's public or private money pouring into an area, it's going to increase the value of the homes around it. If you're looking to invest in Calgary, anywhere along the Green LRT line and the Taza development are some examples that have experienced and will still continue to see growth in home prices. Tip number 2, property valuation. 3 ways to determine value. Valuation is important because it affects so many aspects of real estate investing, including financing during the purchase, listing price, investment analysis, insurance, and taxation. That's why it's essential to use a reliable and accurate valuation method that takes into account all the relevant factors specific to the Canadian market. Now, in Canada, there are 3 main real estate valuation methods: the sales comparison approach, the cost approach, and the income approach. Now, to be honest, I'm sharing these methods for informational purposes only, because for most people, you would get your real estate agent or hire an appraiser to do this for you. It does require experience, so I don't recommend anyone trying to figure this out yourself. Let's break it down in a way that's easy to understand. First, we have the sales comparison approach. Think of this method as like you're looking online shopping for real estate. You're comparing recent sales of similar properties to the one that you're interested to determine its value. This method is great when there's lots of recent sales in the area to give you an idea of what the property is worth. Next is the cost approach. This is kind of like baking a cake.
Yeah, boy.
You're calculating the cost of the land and the construction, subtracting the depreciation, and voila, you've got the property's value. This method is really useful when there are no recent sales to compare to, or when the property has unique features that make it difficult to compare it to other properties. Finally, we have the income approach, which is kind of like being a landlord. You're estimating the potential rental income, subtracting that with the expected expenses, and arriving at a value. This method is particularly useful for rental properties like multifamily units, commercial properties, or rental homes. It does take into account the rental market in the area, which can vary depending on the city or region you're investing in. In Calgary, for example, the rental market had been affected by the downturn in the oil and gas industry in the past. So it's important to consider the rental income for a property. Use these methods when analyzing potential properties, and you'll be one step closer to making a smart investment decision. Tip number 3, be intentional. Know your investment objectives. Investing in real estate can be a great way to build long-term wealth, but it's important to have a clear investment purpose and horizon to avoid any unexpected results and financial distress, especially if the investment is mortgaged. So let's dive into the different categories of investment purposes and what they entail. There are 3 main categories of investments: buy and hold, buy and flip, and buy and build. Buy and hold. This is like planting a seed and watching it grow into a big, beautiful tree. This investment really focuses on large intrinsic value appreciation over a long period of time, and it is an alternative to complement long-term goals such as retirement. So if you're looking for an investment that will pay off in the long run, this could be the right investment purpose for you. This is the most common strategy for most investors. Buy a property and hold on to it for a long term. For the savvy first-time investors, you could buy a home that you could live up and rent down. For example, you can buy a bungalow and live upstairs and rent the downstairs. In Calgary, most basement suites are still illegal basement suites, but the city is making it easy to legalize it. Or you could live downstairs and rent upstairs because you'll get more rent from the main floor. Here's a pro tip. This strategy is perfect for first-time home buyers. By purchasing a home that features a legal secondary suite, you can leverage the rental income to qualify for a higher price property. So as an example, if you qualify for a $400,000 loan, but the desired property comes with a legal basement suite generating $1,000 in monthly rental income, you could potentially increase your purchasing power to $450,000. Now, I'm not saying that is a guarantee, but I wanted to share so you can understand the underlying principle of maximizing your qualification by considering homes with legal suites. My mortgage and real estate team helps people apply this strategy. So if you're interested in this tactic, then give our team a shout in the description below. Buy and flip. This is a term commonly used for buying a property, doing a renovation, and then flipping it, meaning sell it for a profit. For this to be profitable, you need to be really dialed in with your construction costs and the price of acquisition, which is typically where you make your profit. You can also do this by renovating the property while living in it as your principal residence and sell it in a short period of time later. But there are some things you need to know about this. Based on my research, there is no specified amount of time you need to be living at the home to trigger a capital gains tax on the sale. More of that in a second. And you need to follow CRA's rules. To ensure your home is considered your primary residence under the Income Tax Act, you need to hit the following 4 criteria. The property must be a housing unit. You must own the property, either alone or jointly with someone else. You and your spouse or common law partner or kids must ordinarily inhabit the property, and you must designate the property as your principal residence. So the Canada Revenue Agency, or CRA, doesn't have set rules for how long you need to be living in the home for it to be considered ordinarily inhabited. Instead, they look at several personal aspects when determining if a property can be rightfully called your primary residence. These factors include things like your intentions when buying the home, the time that has passed between buying and selling the property, the number of transactions you've been involved with, the primary residence designation you've claimed, and other unique factors. Of course, this is not financial advice, so please consult your accountant and lawyer before taking something like this on. Buy and build. In Calgary, it is common for builders to knock down an old house on an existing lot and build a 1, 2, or even up to an 8-unit complex on the property. These types of homes are called infills, and we made a whole series on them in Calgary. So if you're interested in checking out that series, then check out the link up here or in the description below. We've actually helped a lot of builders in the past purchase lots that suit their needs. In fact, our YouTube channel has attracted a few builders who want to start building in Calgary, and we've consulted them and connected them to our contacts like our designers. If you're a builder watching this and you want to partner with us, feel free to reach us in the link down below. So we've gone through a ton of information so far, but feel free to save this video so you can refer back to it later on, or check out the chapters in the description below. If you want bite-sized info of things like this that's more digestible, then feel free to follow us on Instagram at @liveinnercity. Tip number 4, get the right mortgage. When it comes to investing in real estate, having the right loan structure is important. There are different mortgage loans available, and it's important to understand them to make an informed decision about your investment property. Some of the mortgage options available in Canada include fixed rate mortgages, variable rate mortgages, a home equity line of credit or a HELOC, and hybrid mortgages. Fixed rate mortgages have a set interest rate for the term of the mortgage, while variable rate mortgages have fluctuating rates based on the prime lending rate. HELOCs are like a line of credit that is secured against your home, and hybrid mortgages can be a combination of fixed, variable, or HELOC all in one. Additionally, there are different payment options available, such as bi-weekly or monthly payments. Some payment types like weekly or bi-weekly can pay down your mortgage sooner compared to a monthly payment. Pay attention to the amortization. And the amortization is a length of period in which the entire loan must be paid off. In Canada, it's usually about 25 or 30 years. You could increase the amortization to lower your monthly payments, but you'll end up paying more interest over time. You can offset this though by paying down your principal every year or whenever you are able to, which will shorten the length of your amortization. Now, you do need to know that if you request a longer amortization, your rate will likely increase by up to 20 basis points or 0.2%. All of these options can be a little bit overwhelming.
I'm dying, help me.
Which is why it's important to seek the help of a mortgage broker who can guide you throughout the process and help you choose the best mortgage option for your investment property. And don't forget, getting pre-approved for a mortgage will give you a better idea of your budget and can help you avoid any surprises down the road. Now, it's also important to note that you may not be able to get a pre-approval with every lender out there. Okay, so how do you get pre-approved for a mortgage or find out what you qualify for? Here is an easy step-by-step process. Number 1, reach out to a mortgage broker. And here's a bonus tip. Find a mortgage broker that has a large portion of their business working with investors. This is a specialized skill and it does require specific knowledge and expertise. And if you're looking for a mortgage in BC, Alberta, or Ontario, I have a team in all 3 provinces, so feel free to reach out and I can connect you directly to my team. Number 2, submit your application and income documents. Now, this includes things like, but not limited to, your pay stub, job letter, maybe the last 2 years of your tax returns, current mortgage statement, and property tax information. It is best to have all of these documents ready before speaking to your mortgage broker. Number 3, after a mortgage broker assesses your situation, you can discuss your mortgage options with them. Number 4, choose a mortgage option that is best suitable for your investment objectives. And number 5, start looking for income properties. Our team has a good portion of investor clients in our portfolio all the time. So feel free to reach out to us if you want the 411 on Calgary, where to invest, where the big projects are, and narrow down your investment objectives. Our process is super in-depth. We spend about 1 hour understanding you as the investor before we make any recommendations. So if you want to schedule an investor strategy session, then check out the link in the description below. Tip number 5, what to look for in a real estate market update. So staying up to date on the real estate market that you're buying into is super important, especially when choosing an investment property. As the market fluctuates, you want to keep up with the trends. But what metrics do you exactly look for in a monthly real estate market update? It's nearly impossible to time the market. So instead, look at the months of supply, which can also be referred to as months of inventory. It's the same thing. It means that based on last month's sales, how many months would it take for the market to sell all of its existing inventory? This metric determines if you're in a buyer, seller, or balanced market. Now in Calgary, between 2.5 months and 4 months is a balanced market. Anything less than 2.5 months is a seller's. Anything more than 4 is a buyer's market. You need to find out what a balanced market is in your city, and your realtor should be able to tell you. Here are other supporting metrics to keep an eye on: home prices and sales, new construction activity, property inventory, and mortgage rates. But more important than these metrics is finding a home that fits your investment objectives. Now, if you're looking to invest in Calgary, let's dive into the 2023 Housing Summary Forecast Report by the Calgary Real Estate Board. It predicts that although lending rates may lower sales in 2023, we're still expecting higher sales than pre-pandemic levels, thanks to the growth in migration and employment. But here's the catch. Supply levels remain low, particularly for lower priced properties. Higher lending rates will also weigh on listings growth in 2023. However, limited upward pressure on supply is expected to prevent significant downward pressure on prices as demand normalizes. So if you're looking to invest in a property, keep in mind that conditions will vary depending on price ranges and property type. Higher price homes may see some downward pressure on prices, while lower price properties will continue to experience supply declines relative to sales. So we've gone through a lot, and hopefully you have more confidence in starting to create wealth for yourself. Remember, our team of experienced real estate agents is here to guide you every step of the way, from identifying the best areas for investment to helping you find the perfect property that suits your investment goals. Schedule an investor strategy session with us today. Click on the link in the description below, and let's start building your real estate investment portfolio together. And if you're a real estate agent watching this and you've been feeling like you're stuck in your career or feeling unsupported in your current brokerage, then we have an opportunity for you. If you want to be part of a team that prioritizes collaboration, growth, and success, and you're a dedicated and ambitious agent, we want to partner with you. At our brokerage, you'll have access to multiple masterminds and training every single day, resources and support to ensure that you can achieve your full potential. Don't wait any longer to make a change for the better. Click on the link in the description below to start a conversation with us about partnering up. My name is Felix Chan, Calgary realtor and mortgage broker with Real Broker, and we'll see you in the next video.